Now, talking about earnings and talking about different positions, I had a coaching session today with a gentleman who is in a few married put positions. And I think some of them were the big moves from yesterday that we talked about. And we talked about Microsoft, I think, was one of the ones that he was in. So let's just take a look. Let's go to Microsoft here. Ended up 4% up. It was bigger in the after hours. So you see that jump. It jumped up to 550. Excuse me, 555. That was the open after hours. That was that 10, 12% move. And then it pulled back. Now, I'm not so sure if this was profit taking. I think this was due to the rest of the news in the market, where the news that came out, as we talked about during this big economic week, was a little bit negative, and people were digesting a little bit of the news that came out this morning. These earnings were strong. Meta's earnings were strong, but it pulled back. But I think that's more based on the market as a whole today rather than the potential for further growth and further expectation. Excuse me. So the gentleman was in a married put position. Now, what is a married put position? It's a position we advocate. Of course, you've heard about this left and right. If you've been on Power Options or you've seen any of our discussions, following the rules in the blueprint, Kurt Frankenberg's work that's discussed at RadioActiveTrading.com and shown here on Power Options. We're going to buy a stock for long-term growth, something we think is going to grow 10, 12, 15%, maybe in the next 10 to 12 months. And we're going to buy a put option. We're going to buy an in-the-money put option that's maybe 8, 10 to 12 months out in time. So we're going to control our risk to single digits, to only 5, 6, or 7%, guaranteed, unlike a stop order for these types of events. Although naturally Microsoft and Meta, we didn't see those kind of declines. We saw those increases. But again, the idea is better than a stop order to control risk, but the put actually works as a second working asset. Now, this gentleman has been in a Microsoft position for a while. He rolled up to the 520 strike put, originally, purchased way back here, 450, 460 range, probably had the 480 put. He's moved it up, done other things, sold calls, other income methods. He has a bulletproof trade, means he can't lose to the downside. But he asked me, with this type of movement upwards, what am I going to look to do? What should I do? And the advantage is that the put, even though it lost money on this big jump, it works as a second working asset in your favor. So he was in a position today. We can even look at it from what the cost was 2 days ago, and we're going to go ahead and do that. But let's just say 2 days ago even. Let's go to the option chain. And on a trial, I have access to about 60 days, 90 days of historical options trading data. I just simply want to look at the put options. And I want to go back 2 days. We're just going to take July, and we're just going to go back to the beginning of this week. All right, so let's just go to the 20. Yeah, I want to go back to the 28th. All right, there we go. So if I bought Microsoft at 512.50, and at the same time bought a put that would have matched the radioactive trading techniques, I wouldn't be 4 days out in time. I would have gone... I'm going to take, January's great. That's the position he's in. He's already in January, but I'm going to go further. I'm going to go to March, 235 days away. And I'm going to take the put that he was in. I'm going to take the 520 put at $35. We're going to take the midpoint on that. And these were the closing prices. Again, back on the 29th, the July 28th, my apologies, July 28th for Microsoft. Now let's go to the custom spread tool. Let's build this position. So originally, we're going to buy MSFT on July 28th, closing price. We're just going to use 100 shares to keep the math simple. And we're going to buy it at $512.50. At the same time, I'm going to go out, as I mentioned, to March, or no, was it March? Where's my chain? Sorry, folks. I think it was March the 205, the 232, if I'm not mistaken, 234 days out in time. And we went ahead and said we were going to buy the 520 put at that time. and that was $35. Yeah, okay. So we're going to buy the March put at $35. Just one at 35. Now, am I increasing my cost basis up to $547.50? Yes, I am. Am I increasing my break even on this position to $547.50 on a stock that's trading at $512.50? Yes, I am. But only at March expiration. When I open this position, my put doesn't go to zero. It still has a lot of that time value that still remains on the trade. The initial at risk, the worst case scenario, if I did nothing, if I held Microsoft all the way to March expiration, made no adjustments, accepted no dividends, sold no calls against it, did nothing else with the put, if the stock was trading below 520, the most I could lose is 5%. And I still have infinite upside profit potential. Now the stock jumps. We saw today it's up at 533.50. And originally it almost went up to 545, 550. When I had the coaching session at 11 a.m., it was trading, I'm pretty sure, at about 541, 542 before it continued to pull back the rest of the day. All right. But even now, with the stock at 533, we talked about the second working asset. Now, did I pay $35 for this put? Yes, I did. On July 28th, on Monday, the stock was at 512.50. We're buying a 520 put. So roughly $7, not too much, but $7.50 of that is what? It's intrinsic value. It's guaranteed to get back. So I paid a time premium, of course, of the $35 minus the $7.50. The time value I paid in this position was roughly about $27.50, if my math is correct. Okay? So yes, paid some intrinsic value, paid about $27.50 in time value. Now the stock's at $533.50. It's 13 points above my March 520 put strike price. Where are we right now? Well, the March 520 put is at 27.43. 98% of the time value of that $27.50 time value that I initially paid into the position is still in this put option. But what could I do to manipulate that? I've lost money on the put, sure. I've lost about less than $8 on the put to do what? To gain about $21 on the stock that's moved from $512.50 up to $533.50. There are 4 income methods in the blueprint that revolve around using the put as the second asset. And one of them is income method number 4. And income method number 4 means I'm going to take this time value that I still have on this option and I'm going to swap it for a higher put. I'm going to sell the 520. During the conversation, we were looking at the 545 and the 550. I think he was going to go with the 545 and then maybe sell a 555 call to help pay for this debit. But I'm going to look at this now at 533. I'm going to sell my 520 put at 27.43, and I'm going to buy the 540 put at 35.78. I'm going to roll the put up in strike. Now let's take a look at that real quick. I didn't click the other one in. My apologies. Give me 1 second, folks. Let's go back to March. I'm going to click that again. I apologize. Convert this. We're going to buy the 540. We're going to sell the 520. I've got to simulate closing that 520 put in a sense. All right. Now let's clear up the numbers. Let's say that this cost me 35.80. My apologies. And let's say that I only got 27.40 or 27.35. All right. Now what did this do to my position? Not as much as I thought. When we were looking at it earlier, he was already bulletproof, but this increased his bulletproof status, meaning guaranteed profit, no way that he could lose on this trade, from about 8% to about 11%. Here we reduced the risk from the initial at risk from 5% where we started with the married put down to 2.9. So we only lowered it by 2.1% in this case. That's okay, but why would I do this? What did I do again? I sold my put for $27.40. And we bought a higher strike put for $35.80. So I'm actually entering a debit. I'm adding more capital into this position. I'm increasing my break even from where it was by $8. Whoop, sorry, that got away from me, folks, and 40 cents in this case. But I'm guaranteeing myself a 20-point higher payout. Whereas before, my guaranteed exit was 520. By moving up to the 540 strike, I added the cost of 840 between these two to guarantee a 20-point higher payout. We call this income method number 4 in the blueprint. Why is that so special? Think about it this way. Is there any guarantee you have in the market, buying calls, buying puts, high probability out of the money credit spreads, 50% at the money debit spreads that are 60 days out in time that you're looking to close for a 50% profit, ratio back spreads, butterflies? Is there any position that guarantees that you can pay $8.40 into a trade to guarantee that you're going to get 20 points higher back? No, you can't find that. This is the guarantee. Originally, I could only get 520 back for this position. Now I'm going to get 540 back for this position. Yes, my cost basis went up to 550, 590 with this adjustment, but I paid $8.40 to guarantee a 20-point higher payout, starting with the proper structure and then using this adjustment. Now, I did pay $8.40, but what can I do now? Hey, I can pay for some of that. The movements happen in Microsoft. We saw the earnings. We saw the strength of the earnings. We're expecting it to go further. The market pulled it back. But as we discussed, as I mentioned, maybe I go 10 to 15 days out in time and just, hey, I paid $8.40. Let me get about $3 back. Let me get $3.75 back. Let me go ahead and sell the $5.45 call. Is this going to cap my upside? Potentially, but I can adjust that later. That's also discussed in the blueprint. So now my maximum risk is down to 2.2%, and I have a positive potential return here at 4.2%. And I kind of have what looks like a calendar spread position in a sense. Okay. So that's some of the concepts of the blueprint. When you have the earnings pop, you don't necessarily need to chase it. But it's not just about selling calls. There's other things we can do, such as riskless spread trades or ways to profit in both directions in the married put position going into earnings. That's discussed in the blueprint as well. Of the 13 different income methods I mentioned, 4 of them involve manipulating the put option. The other 8 are generating income to leave the upside open, generating income just as selling the calls we just sold on that custom spread tool. Yeah, I have a capped gain here, but that's perfectly fine. And still do adjustments in that scenario against it. And then again, moving forward, other things to do to take this risk down to 0. And once we take that risk down to 0, that's what we call a bulletproof trade. That if I roll the put again, the stock moves up, Microsoft moves back up to 555. I roll this put up again to 560. I'm probably going to have no risk on this trade and still have potential for 7, 8, 9% profit, more even, without just selling the call. Income method number 1 discussed in the blueprint as well. But that's all discussed there in the full product in the blueprint. You can check that out. If you go to the link for the blueprint, of course, whether you go through the store, you can view the full table of contents and you can see much more information. The power of course, the married put strategy is not just the income methods, but also knowing that you're guaranteed. Let's just go to the basic search, that you're guaranteed that you can't lose more than 6, 7, 8% on any given position, better than a stop order. Going into the earning seasons like we're going through now, these different positions, Robinhood, of course, that actually, I thought, gapped up overnight. Roblox doing really strong here. My daughters are killing me on that. They asked me to buy Roblox at 63 for them, and I didn't. So I'm kicking myself for that, but they play that and Minecraft and everything, and some of the new things that have come out too. But yeah, I'm kicking myself on that one for not heeding their advice, because I do what I do, and how often you listen to 11, 12-year-old. But one of the keys we always discuss is when someone coaching session or a customer emails in and says, what stocks should I look for? One of the most basic things to do is, what stocks do you use on a regular basis? My father-in-law always talks to me about it, and we just got back from a week's vacation down in Virginia Beach, and he says, yeah, well, look at the stocks I buy. I buy dividend-paying stocks. He's been doing that for years, and he just reinvests the dividend. And he says, well, most of the stocks I'm in are what I use. I've got Verizon, so I have that. I've got, a life insurance policy to Prudential, so I own shares of Prudential. When my wife goes out, she buys products from Johnson & Johnson, Procter & Gamble. I've got those. When we go out to dinner, we go out to these places. I've got those. If you frequent Starbucks and you go in there and you see a line, I know the line has been dwindling in Starbucks recently, discretionary spending, as we talked about a little while ago. But, those are kind of the things. Hey, here's a stock that people are using. I'm seeing people here. Everyone's talking about the tech stocks, of course, Palantir, NVIDIA, AMD, things of that nature. Well, that's there. That's here. Affirm Holdings, holding up pretty well. Lack of a better term, bad pun there. Chef's Warehouse is doing pretty well. What are you not seeing here? You're seeing some of the miners in here, some of the bigger miners, but AGI, the one I lost on, CCJ is another one that's been declining recently because they didn't meet their earnings. BC Energy companies, Roblox once again. Robinhood is in here. You've got NVIDIA. You've got Celestica, which is pretty volatile, but it's doing pretty good. But those are the top 13 that match our default criteria that we've been using for years and years. Ernie's in Toast right now. That's a married put he's been tracking for a while. Instead of Goldfields, I took AGI, and it did well, and I reduced the risk by half, but then it had a pullback recently. So we're going to decide what we want to do with that in the Fusion portfolio at radioactivetrading.com.